Well, one very, very pertinent example of this is the fossil fuel divestment movement, which I think has had an impact on fossil fuel companies. If you look at, even since we've been running the index, which is only since 2018, so it's coming up for 2 years, no, 2.5 years now, almost 3 years since we launched it. Wow, how time flies. But when we first launched it, the energy stocks, so the oil and gas stocks in the S&P 500 were about 5.5%. And so, we knew that we were taking that amount out of the index. We were, monitoring that and looked at these percentages. And then last year I was looking at it and it's 3.3. So versus the size of the entire market, energy stocks have fallen from 5.5% of the market to 3.3% of the market. And obviously, the oil price has been weak, but the oil price was weak before. The oil price has been weak since about 2015, 2016, when we saw the oil price crash. It hasn't really, gone up or down so much since then, apart from last year. Last year it was weak, certainly. But a lot of that, I think, has been people's realization that they cannot be growth companies because we cannot afford to be pumping more oil out of the ground and be producing. So they are definitely ex-growth. We are past peak oil. They can only decline unless they manage to find some other business to go into. And so the size of that industry shrinks. And I'll put my hand up and say, I'd really like to see that happen in animal ag, even in some of the meat stocks, versus where they were in 2019 into 2020, they've halved in price. What does that mean for those companies? And especially against a backdrop where the market maybe has been rallying. So relatively, they're looking particularly bad. What does that mean for those companies? It means that it's much harder for them to get any new investment from investors. Let's say that those companies ran into financial difficulties, and we actually saw a couple of dairy companies go bust last year, did we not? Big dairy companies in the US. Let's say those companies run into financial difficulties. Investors look at those companies and say, well, your share price halved in the last year. Why should we put more money into your business if you're not going to make money for us in future? And without capital, if a company runs into financial difficulties without an access to capital, it will go bankrupt. It will not be able to do what it's doing anymore. Maybe somebody else will take on some of the assets. Maybe they'll continue in a smaller way, but in a lot of these cases, it will simply go bankrupt and that activity will not continue. And so the force of, the market is supply and demand. Basically, the stock price is like an equilibrium. The stock price, current stock price at any point in time, is the price where buyers and sellers are matched, okay? If somebody owns the S&P 500 in an index tracker fund, and they say, okay, I've heard about this new index fund product for vegans, VGN, maybe I'll go into that. What are they doing? If they sell their S&P 500 tracker fund and then buy VGM, net, they're selling all of the stocks that we exclude. Because what is VGN? It's the S&P 500 minus those stocks. And because we have to buy, because it's an index fund and it has to be 100% invested, it's overweight all of the things that we keep, okay? So everything that we keep, they're buying a little bit more of, and everything that we exclude, they're selling. What does that mean? The ones that we own a little bit more of are likely to go up in price, and the ones that we exclude go down in price. And that's what leads to things like the oil stocks going down from being 5.5% of the market to 3.3% of the market, is because net, more investors have sold them than have bought them. Yeah? Than have bought other stocks, let's say. That money is flowed away from the oil stocks, and into other types of stocks. And so that kind of shifting of assets away from the standard market benchmarks into ethical benchmarks creates price movement and ultimately forces the prices of those stocks, the exclusions, if everybody who, there's about 10 trillion in the S&P 500. Okay, 10 trillion is benchmarked to the S&P 500, which means that it is very close. Those portfolios will be very, very close to the S&P 500. If even a small amount of that was to come out of the S&P 500 and go into VGN, it would cause massive selling pressure on the prices of those stocks and make it quite difficult for those stocks to continue in business.